Hello, everybody. It's Mike Preston at New Harbor Financial Group. It is November 8th, around noontime. So here on a Wednesday around lunchtime, we wanted to give you a brief update on the week. Let's start taking a look at the big picture. I'll articulate some of the things that we're looking at right now. Let me share a couple slides. So taking a look at this slide, you can see this is one that we have shared quite often. This is the great work of John Hussman. And this is just the big picture. It does nothing to help you with short-term timing, but this is a chart that goes back 100 years. And essentially it shows the S&P index as the dark blue line here. And then the green line is roughly what the S&P index should be trading at or would need to be trading at to generate about 10% annual returns. So the big picture is that the S&P 500 became overvalued in the late 90s, and it's never really been allowed to correct. It tried to correct two times. Well, you may say more than two times, but really two big times. The one time was the tech bust in 2000 to 2002. The market really didn't even get to equilibrium or to a clearing level here. It was rescued with 0% interest rates. And of course, that created the housing bubble and subprime mortgage mess and all of that. And the great financial crisis of 2008 brought us to a level that would generate expected returns of about 10%. And it stayed there for all of a week or so. And then, of course, the market was rescued by a repeal of mark-to-market accounting rules by the Fed. And then we went off into this experiment called quantitative easing, Operation Twist, TARP, everything else. And, it's really never ended since then. The market has tried to correct a few times, but each time has been met with a wall of liquidity of even larger and larger degree each and every time. So, this model, we respect John Hussman's work a lot. There's others that do similar work. This model, I think, is statistically valid. The only question we can really ask is it ever going to matter again? We don't know for sure. I think it absolutely will, but the market would have to be trading down around 1800 or so, which is well over a 50% decline here, 70% plus from the recent high on January 4th, 2022. It would have to be trading down there to generate 10% returns. From these levels, we can expect negative returns. We don't know if that's going to happen annually in a very kind of controlled fashion, or if it's going to be some kind of crash with a clawback to even over the next 10 years or more. But the big picture is the market remains extremely overvalued. And I'm going to share a different chart here now. I'm going to share the chart of the S&P 500. Take a look at this. This is the daily chart of the S&P 500. And we have a nice head and shoulders top here that broke down and confirmed that head and shoulders. But what happened last week was an absolute face ripper of a rally, 6 or 7% in 1 week. It was the best week of the year. It was quite surprising to us, but it did happen. And frankly, it caused our short-term indicators to reverse up. And so the bullish percents, one of the indicators that we look at, reversed up on all three major index, the S&P, the NASDAQ, the New York Stock Exchange, and a number of other things in the short term have reversed up to a positive direction. We don't like it. We don't like this permanently high plateau that we've been living with, but we show you a weekly chart here now. You can see this old top back in January of 22. It controlled decline all year, a big rally off the October low, and everything looked like we were rolling over and potentially moving down, still to what I think is going to be at least the mid 3000s on the S&P. But last week we had this big, huge up bar. And look what it did. It brought us right to this downtrend line, all at a time where our short-term indicators are reversing up. So this causes us some concern that we might get another kind of melt-up scenario, maybe one last hurrah. Going back to the daily chart, you can see we're right there at that downtrend line. So we had essentially 6, 7 straight up days in a row, and right now we're chopping sideways. We'll see what happens next, but This action, along with our short-term indicators reversing up, caused us to adjust the hedge that we had on. We have an S&P 500 put, or had an in-the-money put that expired in December. We decided to take a profit in that and replace it with a put that expires out in January that's out of the money. So we had one at around 450 or 4,500 up here. We replaced it with one down at around 4,100. So it's out of the money. We're not risking much on that hedge, and we still have a good hedge if we get a crash or a meltdown. But short term, as much as we hate to admit it, the risk seems to be that we might pop higher. If we break out, if we have another, let me go back to the week. If we have another week like last week and we break significantly out of this downtrend, as much as I hate to admit it, I think we might run higher here. So we've adjusted things because of that. And also in a minute here, I'm going to show you some other charts that, that show you some of the sectors that we're looking at. We're always scouring the market for sectors that make sense. It's really hard because it's a very, very narrow market. The equal weighted S&P is essentially flat on the year. The Russell 2000 is flat on the year, while the S&P itself is up almost 15% and the NASDAQ well over 30%. It still remains a market of 7, 8, or 9 stocks. If you're not in those stocks, you're not making money. It's not a good sign. It's not a good sign when you've got a narrow market. I feel like we've been beating that drum for a long time, but that's exactly what's been going on. So take a look at these charts. We're always looking at different sectors, particularly when indicators are reversing up, when the market threatens to break out of a downtrend. We're taking a look at individual sectors, and then eventually often we'll look at individual stocks. I kept it at the sector level here. This is one tool that we use called point and figure charting, one of the many tools we use. But the nice thing about the X's and O's is it compresses time, and you can stand back and take a look at a bunch of different sectors very quickly. And I have highlighted really the best charts that we see. On the left-hand side, this is price. On the right-hand side, it's relative strength versus the broad S&P. One of the better looking charts out there, believe it or not, is gold. Gold has been knocking on the ceiling there at 2,000 and frustratingly has not definitively broken through yet. But it looks like it wants to, and it's been doing this even when the dollar has been strong, which is good. So we may need a little more patience here, but everything on gold looks really good. I believe we're going to break through 2,000, and when we do, I think it's going to run further. Let's take a look at the next chart. So really drilling down into sectors, it's only a couple sectors out of all of them that look good. We're looking for good charts that are consolidated, that haven't been too volatile. What you want to see is a chart that's going sideways. You also want to see relative strength, strong versus the broad market. Insurance is one that we're keeping our eyes on. Insurance looks positive. We haven't added it to the portfolio yet, but it looks positive. Another one that we would like to have a position in, but really hasn't confirmed, in fact, it's looking like short term it's breaking down, would be the whole oil and gas and energy sector. So there was a big monster move here, back a few months ago, consolidation, but now it's breaking down, and relative strength versus the market has turned negative as well. So a lot of people ask about energy. We like energy long term, but we're not adding it here because of the short-term weakness and the reversal down in relative strength. And I wouldn't say that we would definitely do this exact ETF, this oil service sector, but we may look at something like XLE or even one of the big refiners. But frankly, if we get a further drop in this, and that could concur with a drop in the S&P 500, we may very well nibble on it. Take a look at technology, equal weighted technology, because it is a market of 7, 8, or 9 stocks. Technology has been a leader. So we have to admit that technology looks good here. This is an equal weighted ETF. It's been trending sideways. It looks to be breaking out of what we would call a high tight flag. Relative strength looks good. So if we get a continued strength or continued strong signals from the market, we may nibble a little bit more in insurance or technology or one of these charts that looks really strong. And so it's tough. We think the big picture is real, just extreme overvaluation. We think the market continues to have crash risk. And yet at the same time, we have a solid challenge of this downtrend on the S&P. We have our short-term indicators reversing up. So we're watching closely. We're meeting all the time, several times a week to talk about this. We still have 40+% in treasury bills. We're frustrated we're not getting a bigger pullback in the market. But at the same time, we're keeping our discipline. We have very light overall exposure to stocks. What we do have is hedged, and we hope to have some better opportunities soon. So thanks for watching, and we look forward to talking with you next week.